Chris, thanks very much for joining us. A lot of focus at the moment on logistics, and a number of commentators seeming to be very upbeat on UK logistics investment, particularly for 2024. So I guess, what's your take on that?
Hello, Richard. Yes, probably the million-dollar question I'm asked at the moment. In short, I'm very positive. 2023 was a very tough year for a number of reasons, but giving a proper answer, I think you've got to take a step back actually and almost look at a higher level. And let's just talk macro. In the UK here, we've got interest rates at the highest level for 15 years. They appear to have peaked and everybody's now expecting a fall. So that's positive. Inflation, that has come down dramatically. And then also you've got the elections here in the UK, as many folks do across the world. But really probably different to previous elections is not going to cause a disruption. And that's the sort of unknown quantity that a lot of elections do. So in terms of that level, it's much better picture going forward. But then actually now diving down into more the micro level and what we call the pure logistics play, for me and a lot of people in my position, it's all about occupier demand. At the end of the day, if we develop or if we buy, have we got a tenant there? Are they going to stay? Are we going to get rental growth? And so here in the UK, it's that structural change we've had. And by that, I mean, we've got e-commerce. This is e-commerce penetration, by the way. That is at 26%. It was higher during COVID, but it has come down more to more stabilized levels. That is predicted to go to 30% by 2028. So that is a continued trajectory of growth. We are, incidentally, the third highest in the world. And that linked with population growth, which is, again, significant. The other thing is nearshoring. We hear a lot about that. So we've had Brexit, and also due to the unfortunate events, geopolitics with the wars at the moment, but nearshoring, and now just in time is now just in case, as it were. And then we've got the urbanisation, almost that last mile, which is now really the 1 hour delivery times, and that's putting more and more pressure. So it's that continuing occupier demand. The key surprise for me is all about the take up. Now, everybody's talking about 23 being a bad year and what a dramatic reduction it was compared to the previous year. Well, it's not surprising because we've had 3 years of the COVID and post-COVID, which were at phenomenal levels. 2023, the actual take up was literally just sub 30 million. And the average before the COVID was literally just over. So that is very, very encouraging. I think the other encouraging bits of information have come out recently. We've had 2 years without Amazon in the UK. They pulled back from the market. They've literally now just announced that they are taking a 2 million square foot unit, Segro, up in Northampton, which is, that's big news. That's a big sort of boost back to confidence. I know reading the articles on it that Amazon see the economy's now turned the corner here and they're back into growth trajectory. Added to that, we've also had Tesco down in Aylesford, Kent. They've taken a 620,000 square foot distribution unit, and that's the all singing, all dancing, chilled, ambient, and normal. So those are two big fillets in the market, which other operators, and we know that Marks and Spencer and Sainsbury are out there as well, expanding. And I know that other people will come back and say, well, look, hold on, the fashion retailers, ASOS and Boohoo, yes, and that is leveling out. But the good thing about UK is we're not just dominant on one sector. And okay, we've got specifics in various countries, but in the UK, we've got a third is probably 3PL, a third is manufacturing, and then the third is what we call the e-commerce retailers. A nice blend. The other aspect is constrained supply of land. At the end of the day, we're relatively small, and I always say, compared with my German colleagues, Germany is 1.5 times big enough, and their population is actually only about 15% big enough. So per square foot per person, there's a lot more pressure on here. We just don't have that space to grow. So that always in the back of my mind. People tap me on the shoulder and they'll go, Chris, yeah, hold on, vacancy rates have shot up here in the UK, and they have in the last 12 months. That's partly because we've had a splurge of spec development. That needs to be eaten up. A third of that actually has already been let already. But also the interesting fact is, to do with the ESG, a lot of the existing occupiers have put their space back on the market, and that actually is different to what we'll be buying and a lot of the institutions will be buying at the moment or in the future. That's more secondary stock, and this, what we're talking about here is very much the prime end. So I definitely see those figures on vacancy rates dropping down, and all the major agencies and commentators have said the same actually. So for me, it doesn't cause that much problem.
And Chris, it'd be good to just get your sense of what's happening with net initial yields.
Peak of the market, we were down literally just over 3% here in the UK. Now, prime, I think we're at 5.25. London might be a bit sharper, and the regions is probably about 5.5 at the moment. We've got two deals of just over 100 million where Aviva investors are buying a multi-let estate, and that's literally just around the sort of 5%, and that goes out to 5.2%. And then Mirastar buying another one in Coventry, again 4.8 going to 5.2. And then we had obviously, which has been out of the market since September. Both those are incidentally under offer, just going through. And then we've got DTZ investors, they bought Coventry Logistics Park, 4.8%. So that gives you a feel. The reason I mention that is because it links well with the core plus market. Well, definitely the core is coming back in the UK, and we know across Europe and across the world, core money has gone very silent. And this is very much the first indicators that they're coming back to the market as well, which is good for everybody. I think the problem is actually it's going to be a scarcity of actual stock. And until we get that dislocation between the pricing of what a vendor and what we're, or our investors, are prepared to pay. But it very much is the UK. It always is this way. Last time with the financial crash, it was very much we were the first and the quickest to go down, and we were the first and the quickest to come back out. And the charts and the indices are exactly the same this time round. So have we reached the bottom of the market? Yes. Is the market going to come back? Yes. The speed of it, I think that is now really in the hands of where we see the interest rates and the inflation figures go, and those both go, as we know, very much hand in hand in the UK.
Looking at the rental side, UK's traditionally seen strong rental growth in the logistics sector. Given the background at the moment, do you feel this is sustainable? What's your take on that?
That is, along with occupier demand, is rental growth is what gives us our return. And in today's market, rather than just sitting here now and sitting here waiting for basically yields hardening, this is very much going to be an income play market. And so that is going to be very much dictated by rental growth. Now, rental growth last year, actually, some houses, research houses, are coming out saying 23 was as much as 7%, which actually is pretty good. That isn't as good as in the UK we've had for the last 2, 3, 4 years before that, where we're in excess of double figures. Our research, we feel a conservative figure is 3.5% to 4% for next year. The reasons being the constrained land supply, and we're up against competing other land users. So residential, obviously a big user, and especially when we're coming to the urban logistics. Historically, it used to be residential used to have the higher prices, so we all lost out. And interestingly now with the rent, rents in London, Park Royal, £32.50, £35 per square foot, which is way in excess of anywhere else in Europe. In the UK, planning is also a very slow process. So that is reducing the ability to develop this stock. We're obviously developers as well, but that then reduces the stock coming through in the market of completed. But we've obviously on the back of that had 2 fallow years of spec development. So that is actually going to see our vacancy rate is sub 6.5%, 6.75%. We see that falling away pretty dramatically. But I think one key message to end with is a very pertinent point on ESG. And in the UK, the spread between prime and secondary is at its greatest. That is in terms of rents being achieved. And we see that becoming even greater. And so the rental growth will be very much on the prime end, the ESG, BREEAM, excellent. And dare I say, it's probably going to have to be excellent these days as opposed to very good. In any of our modelling we do, be it either an existing unit or brand new spec scheme, ESG is right up there now because we can just see that push just becoming greater, which is the same with my colleagues across Europe, but it's very much in the UK at the moment. It is absolutely number one, and it's a key aspect for us.
Yeah, and I think in a lot of ways there, the UK acting as a bellwether for the rest of continental Europe, and very interesting to see that more obvious bifurcation in the market between sustainable and non-sustainable stock there. Thanks very much for joining us, Chris.
Great pleasure. Thank you.